The following program paid for by Lifespan Wealth Management. Providing financial advice since 1993. It's time for Your Money with Sherry Goss, Randy Goss, and Jonathan Eisner. And now from the Macon studios of News Talk 940 WMAC, it's Your Money.
Good morning, Middle Georgia, and thanks for tuning in to Your Money, produced by Lifespan Wealth Management. As financial advisors, the main thing we do is provide retirement planning advice and manage our clients' investment accounts. So if you're looking for an investment advisor, call our office at 478-922-8100 to set up your complimentary consultation.
Lifespan Wealth Management has offices in Macon and Warner Robins for your convenience and has been serving Middle Georgia for over 30 years. You can learn more about our services by visiting our website at retirerelax.com. And while you're on our site, go to the special reports section where you'll find several reports that are available to you for free. You can also sign up to receive our digital feeds, which are short videos providing great information relevant to retirement, investing, and matters that affect your money.
We also offer seminars to the community at no cost. So if you're in need of a guest speaker for your church or civic organization, give us a call, and together we can decide what topics you would like us to present to your group. Again, our contact number is 478-922-8100.
All right. Good morning, everybody.
Good morning.
Good morning.
Thank you, all of our listeners, for listening to Your Money. A couple of headlines to start us out. Jerome Powell has warned that we should not count on a December rate cut just yet. The Fed is extremely divided. According to Powell, a further cut is not a foregone conclusion, not by any stretch. The top Social Security tax is rising 4.8% as benefits themselves creep up 2.8% for 2026. If you are flying Delta this holiday season, make sure you bring the credit card that you used to book your ticket, or you may not be able to board the plane. They just brought this rule back, so please let your family members know if they are flying on Delta for the holidays.
That'd be horrible.
It would be
On top of a
horrible.
flight delay.
Can you imagine?
No, that's awful. Oh, anyway, hopefully they're sending everybody an email. This week, ADP reported that U.S. companies added a greater than expected 42,000 jobs in October, though growth was nonetheless muted compared to earlier this year, according to the payroll processor ADP. Small and medium-sized businesses broadly lost roles, while large employers were hiring more. The ADP report comes amid a virtual blackout of official employment statistics due to the ongoing government shutdown, leaving economists and analysts to examine whatever alternative numbers they can get their hands on.
All right. And governments are likely to pillage the $80 trillion in the Great Wealth Transfer to fund the national debt. Eye-watering sums due to change hands via the inheritance in the coming decades will change the financial fortunes of millions of people, but it could also help rectify the financial trajectory of some of the world's advanced nations. Those funds could be used to balance the books for countries with high levels of unsustainable national debts. Studies have found that over the next 20 to 30 years, as much as $124 trillion will be passed down from older generations to the younger counterparts. The baby boomers were born between 1946 and 1964 are the wealthiest generation in history. As these individuals begin passing on this money, sums will go immediately to their Gen X, Millennials, and Gen Z successors, and some cash will go to the spouses. But UBS chief economist Paul Donovan believes the governments will want to add their names to the list of recipients.
That's right, and they already have in the U.S. due to the 10-year rule. If a non-spouse inherits an IRA in most cases, that IRA has to be liquidated within 10 years and taxes are paid with each distribution. Depending on the size of the account, I've seen non-spouse beneficiaries liquidate these accounts as soon as they are inherited, and they use the money to pay off debt, go back to school, or buy a house. It can be life-changing. However, in some cases, I wanted to cry as some chose to liquidate the account to get something they just wanted, not needed, like an expensive vacation. I try to help people make the best decisions with these inherited assets, and I'm not always successful, but the 10-year rule is a big deal and part of this whole plan.
Yeah, a lot of people just look at this inherited money as free money. And
right.
Wasn't it y'all's friend that bought a cruise for her friends?
Yep, $20,000 just gone.
$20,000.
Gone.
Vanished.
And her husband wasn't even invited.
Yeah.
Good Lord, insult to injury.
He's still sore about that.
I'm sure he is.
Oh, my gosh.
Back to the article. So, interestingly, a study from J.P. Morgan earlier this month found that women expecting to receive a spousal inheritance over the coming years, which is an anticipated $9 trillion, plan to invest it in the stock market. Part of the reason they're comfortable investing the money is that they're not relying on it to achieve their financial goals. With 3 in 4 women saying that they're well on track to reach financial milestones without receiving any inheritance from family or spouses. The very fact that women will have power over such sums has an impact on the real economy, as according to experts, women invest differently than men. On average, women tend to be much less emotional investors. They do more research, and when they do invest, they tend to stick to the investment over the longer term.
That is interesting. So they are talking about spousal inheritances, where the money becomes the wife's as if it always was hers, and she only has to take required minimum distributions annually based on her life expectancy. I meet with people every month that have never heard of this, which just blows my mind.
Much attention has been focused on the budget deficit in the U.S., the world's largest economy. Economists aren't worried about the volume of the government's debt, which recently hit $38 trillion. So much as how quickly it is accruing, borrowing costs with no sign of slowing spending. There will be a moment of reckoning, analysts are convinced, when either bond markets opt out of buying any more U.S. debt because they believe that its path is unsustainable, or that the central bank is forced to intervene with quantitative easing, thus lowering the value of that debt.
Economists have both been bemused and pleasantly surprised by the solutions proposed by the Trump camp. For example, Trump has touted a gold card plan for visa policy, which would charge rich immigrants $5 million for a green card plus a route to citizenship. Trump said a million cards would be worth $5 trillion, and if you sell 10 million of the cards, that would be worth a total of $50 trillion. Well, we have $35 trillion in debt, so that would be nice, he said. He noted that he would have a $15 trillion left over if he managed to sell 10 million of the cards.
I need to look up and see if anybody has any interest in something like that. Just curious.
I mean, it's not a bad idea, but I mean, how many people are going to be willing to pony up $5 million?
How many have it? You know?
Well, I mean, there's a lot of people with that kind of bank rolling around out there. We just don't see it.
People that are trying to come to the United States for
Yeah.
a better life?
Yeah.
Just probably sell drugs.
That's what all those people in the white boats coming across the Caribbean are. They're trying to get here for a better life, right?
Right. And
Right.
for drugs.
A new TIAA survey finds that 2/3 of Americans believe retiring between age 65 and 70 is no longer realistic, with only 37% confident that they can retire on time. Financial strain is widespread. 20% of respondents aren't saving for retirement at all, and nearly a quarter expect to work longer just to cover basic expenses. So basically, Americans struggle to stay on track for retirement as confidence declines. Some are even turning to unlikely strategies, such as the 10% who see playing the lottery or buying luxury goods as potential retirement solutions. TIAA executives warn that many Americans lack both adequate savings and access to financial guidance, underscoring the need for guaranteed income products and professional advice.
The survey shows 92% of respondents want a steady income stream beyond Social Security, yet 25% of them feel too uninformed to invest in annuities despite growing interest in them. An annuity may be a solution, so let's get you some annuity basics.
Okay. There's a basic misconception about annuities, and you can just mention the word to some people, and the reaction is terrible. It's almost like you have insulted them, but we understand why that's the case.
That's right. We have to explain the annuities of the past are very different than the ones that we see and use for our clients in today's environment. They can be very complicated and hard to understand. We do our best to explain them in a way that our clients understand them, and we always exercise full transparency when transacting an annuity for our clients. So let's discuss a few of the annuities that are out there.
All right. First of all, the MYGA, which is a multi-year guaranteed annuity. This is a basic annuity that locks in an interest rate for a period of years, be it a 2, 3, 4, 5, all the way up to a 10-year. The interest rates are guaranteed. Its interest is compounded year over year, and at the end of the period of years you have chosen in the contract, you get your initial premium back with interest.
Interestingly enough, I have a client who bought a MYGA probably about not quite a year and a half ago. And this week has been a tough week in the markets, as we've seen. And she called me this week, and she said, "Hey, I just wanted to make sure everything was okay with that account." And I said, "Hey, everything's great with that account. It's getting the 5.4% that that was guaranteed to you, and it's getting it every single day applied to the account." She was like, "Well, that's exactly what I wanted to hear. Thank you." So there's a little bit of peace of mind with getting a locked-in rate for a period. I think hers was a 7-year, and so in tumultuous times, especially retirees, they like to get the fixed guaranteed rates.
That's right.
If you want to continue deferring, to your point, Randy, when you at the end of that period of the MIGA, if you don't want to liquidate it and pay taxes on the gains, if you can continue deferring taxes, if you just roll it into a new annuity contract at the end of the term, and then taxes will continue to be deferred for the length of the new contract. So these are things that you need to talk to a financial advisor about. There are some things that you can do that can be advantageous in terms of taxes and deferrals and things like that. Second kind that we work with is fixed indexed annuities, or FIAs. These are a type of deferred annuity that allows the premiums you contribute to grow for a number of years before taking income in retirement. The primary advantage is that this type of annuity offers protection against market loss and the potential for gains based on an underlying stock market index like the S&P 500, for example. These contracts are guaranteed by the carrier and designed to accumulate savings over time and may provide income to you in the future. Your earnings typically aren't taxed until you withdraw them. After the accumulation period, you can choose to receive a lump sum, spread payments over a fixed number of years, or receive income for the rest of your life. There are a lot of options.
There are a lot of options. And unlike some annuities that expose you to market risk, fixed index annuities protect your principal until you decide to take the guaranteed income in retirement, while offering tax advantages and market growth potential and a floor to protect against losses. It's tied to an underlying market index so that when the index rises, so do your gains, up to a limit outlined in your contract. But it's important to know that the interest you earn won't match the index total performance due to fees, rate caps, spreads, or participation rates. On the other hand, if the index falls, your principal is protected from losses, and each company has different mechanisms for protecting against those losses. So be sure that when you speak to your advisor to ensure that you understand how these mechanisms work.
Yep, and here's an example. One product may have a cap of 12% on the upside and 0% floor on the downside, meaning if the underlying index makes 13% that year, you're going to get 12, which is the cap. However, the trade-off is that if the market is down 10% in that same year, yours goes down 0, because that's the floor. Another company may have a 15% cap and what's called an 8% buffer to the downside. So if the market loses 16%, you make 15%. If the market loses 8%, you lose nothing. But if the market loses 9%, you are limited to a 1% loss.
Yeah, and this seems confusing the first time you see it or hear it, but it is, every company has a little bit different way of trying to do this.
Right.
And we don't necessarily like these because it makes no sense in creating something. Why not just create a simple product, just like the first one we said, when it hits 0, you're out of the market until it crests back above 0. Right. Why not keep it simple, But there are some disadvantages. The growth of these indexes is not guaranteed in any year, but each year you do get the opportunity to review and adjust the indexes that you're in. And caps and fees and spreads and other costs could eat into your return. So you always have to ask these questions when you're talking to a person that is trying to market one of these indexes to you.
For sure. And let me point out real quick before you say your part, Corey, that the neat thing about the 0% floor is that, let's say that you have a year in which you get 10%. So your accounts, you put $100,000 in, you're at 110. Now 110 is your new floor.
That's right.
That's your new established floor. So if the next year is back in the negative, your original 100 isn't your floor. Your new established 110 is your floor. So
that's a very good point.
Yeah, so it's cool because it kind of steps up every year that there's a positive gain. It's going to step up. So
good point.
And something you need to always remember is that when you're talking about annuities, they have surrender charges. Be sure to inquire about them when you discuss annuities with your financial professional. And if you need to take out all or a portion of the principal out early, there is a penalty for that, and that is what the surrender charges are.
You know, and on this point, some of these products, they have a free withdrawal every year, say 10%. Or the interest that you've earned in that year without penalty. So if you've made $4,000 or $5,000 that year, you can take that amount out without penalty. But if you need more than that, you're not being penalized, or you're not having to pay a surrender charge on the entire amount that you take out, only the amount above and beyond
the free withdrawal amount.
The free withdrawal
Yeah.
amount. So
Good point.
So, Kat, that is really good information. So, another option I have seen quite a few times is to quit the job you hate. And we're talking about saving money for retirement and making that work out for you. Quit the job you hate and get a job that you like that still provides benefits. The pay may be lower than what you currently make, but this helps you delay taking Social Security so your benefit is larger in the future when you do apply. And you can continue to save more money in an investment account. To really understand this, log into SSA.gov and see how your benefit will increase the longer you work and the better off you're going to be. Another option, downsizing. Yes, the thought of moving is right up there with getting a root canal, but Randy and I can tell you that we did just that. We sold the big house on the golf course and moved into a loft in Macon. At the time, we did not do this because of the mortgage cost, but it did save us several $100s a month in mortgage payments. And that does not even take into account the savings we realized on the yard maintenance, which was massive, and the repairs and maintenance we had to do on the home. With the house, it's always seemed like something was breaking. And since the loft was newly constructed, it had a lot less to break.
right. And if you have an older home that needs a lot of repairs, you may consider acquiring a home warranty that can help offload some of the repairs to the insurance company, basically, so that should they occur. Of course, that would require an upfront out-of-pocket cost of a few $100s.
And you have to do that when you buy, right? Or can
no,
you do
you
it
can
later?
buy that at any time. Yeah.
Okay.
And the other benefit of downsizing was that it forced us to clean out the attic and get rid of things that we had completely forgotten about that we just thought we might need.
Unbelievable, like
Clutter.
10 Christmas
clutter,
trees.
yeah. So it was great.
10 Christmas trees.
Another option is picking up side gigs. I always try to pick up side work whenever I'm not busy, and that seems to be the vast majority of my weekends. I try to go down to Florida as often as I can, and I always make a point to do some work when I'm down there. Growing up and living there most of my life, I met a lot of people, and there's always someone that needs help with something and is willing to pay you to take the load off themselves. On Saturdays when I'm down in Florida, I do home repairs, maintenance, or even low-level construction. When I went down there a couple months ago, I even helped some people move furniture into their new house. There's always something to do. You just need to know where to look and who to ask. The work I do covers the gas to get there and back, and even covers the costs of just what I end up spending while I'm down there.
That's fantastic. Plus, you're always learning something. One more, side gigs. Here's a few examples. Working as a customer service rep can be an excellent side hustle. You can work part-time for a company or freelance on an hourly basis. Plus, like many great side hustles, you can find remote work, fully remote work, in customer service. The author of this article did a quick search on Flex Jobs and found over 64,000 job openings in customer service. On Indeed, they found over 100 part-time jobs and over 70 contract positions for remote customer service jobs. I have a client that does the following for extra cash: pet sitting, and she loves it. She will even stay in the home while the family is away due to the pet needing regular medication and care. In other cases, she walks dogs or just stops by to feed cats and clean a litter box. She loves animals, so loves doing this for other people. You can easily advertise this sort of service on Facebook, in local community groups, or at your vet's office if they allow advertisements, and via word of mouth through your family and community. Plus, with the side hustle, you'll be able to set your own hourly rate and choose which jobs you accept or reject. The author suggests that Rover is a great website or app to help you start building a business of this sort.
Yep. But the moral of the story is this: when you're feeling stressed out about anything, especially money, it means that you need to stop, sit down, make a plan. If you're feeling financially stressed, there's nothing like a good action plan to help you visualize a brighter future and give you control over your finances.
And I would like to say something else on that, Jonathan. That's a good point you just had. You know, this when you are feeling stressed about money, don't sit around and feel sorry for yourself. I mean, put that plan in place.
That helps nothing.
It helps nothing. But it would help if you sat down with a friend and said, hold me accountable to this. You know, an accountability partner is a great way to do it. But I mean, if you got a financial advisor, if you don't have one, get one. I mean, that they can help say, yes, this is a good idea. You're on the right track. You know, This is how you get on good, stable footing. So do this, do that, don't do this, don't do that. Someone who really knows what they're doing. So if you're going to do that, have a friend, that's great, but make sure the friend knows what they're doing.
Yep.
So anyway.
Agreed. Money in motion. IRAs, 401ks, 403bs, TSPs, SEP IRAs, and all other qualified plans are being rolled over in large numbers. There's over $43 trillion in these plans, and it's rolling over at a rate of about $800 billion every year. Why is there so much rolling from these plans into IRAs? Well, consolidating assets in one account makes management easier and simplifies the calculation of RMDs, or required minimum distributions. IRAs typically offer a wider range of investment choices compared to workplace plans, and some options provide guaranteed income for life, which is probably something like what Randy and I were just talking about a minute ago with annuities, as well as principal protection and secure growth. Additionally, IRAs help reduce or eliminate market risk, fees, and loads that are often associated with other retirement plans. The majority of our clients want to avoid large losses. Randy actively manages our portfolio to avoid those large losses.
So when I met Steve Rosenberg many years ago, this is why I joined his firm. He had a portfolio manager at the time who stopped out of holdings that were going down in value and watched all the holdings in the managed portfolio on a daily basis. I love this compared to a buy and hold portfolio, and we continue to do this for our fee clients today. So if you're interested in taking a look at how we actively manage money, call us for a free consultation, and we can take a look at your current investments and explain what we do for our clients.
Yeah, we had to part ways with a particular holding that we liked. We personally liked a lot this week, but we're protecting the clients. And
That's
so
right.
we had to let it go because the forecast didn't look too stellar on it.
Yep, that's a good point.
Yeah.
Now for a story that comes with a warning. Her husband died unexpectedly. She spent a year untangling their finances. Alice is a retired university professor, but the 75-year-old has long struggled to grasp the language of finance. For decades, her husband, a professor of linguistics and computer science, whose name was Sasha, managed that aspect of their life. When he died unexpectedly last year, that task fell to Alice. Immediately, she felt overwhelmed. She spent hours poring over a convoluted spreadsheet that he kept and found communications with several different financial advisors. She tried to figure out how much she could afford to spend each month worry-free and puzzled over why Sasha purchased a single share of what appeared to be every stock in the S&P 500.
This sounds terrible. Yes, how overwhelming and confusing. And unfortunately, this is not uncommon. Her experience highlights the danger for couples when knowledge of their finances is concentrated in one partner's head. If that partner dies first, the other can be thrown into learning how to manage their finances during the time of profound grief. About half of surveyed women said that they felt prepared to manage their finances after their spouse's death, according to a survey by Thrivent.
Alice understood when Sasha was alive that she would be in a vulnerable position if he were to die before her. Once or twice a year, she would panic and ask him to walk through their finances together. After a few minutes, she would zone out and he would lose patience. The spreadsheet he created was a mess of account numbers and annotations that only he could understand. The couple always figured they could discuss their portfolio at another time.
After Sasha's death, it sank into her that her husband was her husband of almost 50 years was gone. It also hit her that she would have to untangle their finances. She knew they had over $1 million, but she only had a vague sense of how their money was being allocated. She had trouble understanding the jargon of investing and was confused by terms like ETFs and index funds. And she admits it's because she has no interest in learning about investing or managing money.
Mail regarding their various accounts came in, and Alice, overwhelmed, piled up unopened on Sasha's desk in the bedroom. She would occasionally scream to herself in frustration, not understanding some of Sasha's decisions. As she started managing her finances, Alice was worried she would be scammed, given her lack of knowledge. After all, her husband Sasha lost about $350,000 of the couple's money in a Ponzi scheme a couple of years earlier.
Wow, that's not fun. Because women tend to live longer than men, they usually have more years of retirement to plan for. Understanding the level of investment risk they're comfortable with and whether that is reflected in their portfolio is crucial. She recommends that couples keep a shared list of their accounts and passwords in a secure place. This is absolutely critical, and we'll talk more about this in just a minute. In the weeks after Sasha's death, Alice found email exchanges between Sasha and 2 advisors from different firms. Alice felt more comfortable with one of them, and with his help, she consolidated about a half of a dozen investment accounts, rolled over others to prevent a large tax bill, and swapped some individual stocks for cash and municipal bonds to reduce the risk in her portfolio. More than a year after Sasha's death, Alice no longer feels overwhelmed by her finances. Looking back, she regrets not learning about them earlier. She wishes she and Sasha had recorded a video of him outlining their accounts and the rationale behind each investment. Alice says she still isn't an investing whiz and doesn't intend to become one, but she understands her finances now, and so do her 2 adult children, whom she has included in many of their meetings with Reed, the financial advisor.
I've seen this many times, and it's very stressful. If you and your spouse or you and your kids have this sort of situation, call our office and make an appointment with one of our financial advisors. They will go through income sources, debt, monthly expenses, and investment accounts. They will explain the types of accounts that you have, when you have to start taking distributions, and how to work through that, and help you lay out a future plan for cash flow.
We recently met with a man who is 10 years away from retirement, and he had multiple old 401k accounts, and he didn't understand what they were invested in. One of his accounts had changed financial companies twice since he had left. We explained how we could consolidate those accounts, and we looked up his current investment funds, which had not done much of anything in the past 5 years. Now he has an advisor who will answer any questions he has, manage his portfolio, and watch the holdings and make changes as necessary based on market risk. He was very relieved to get advice and help with this.
Yep, this particular story deals with the death of a spouse, but it can also be very hard to sort through finances after a divorce. We've seen it many times. One spouse is the breadwinner and handles all the finances in the house, and then after the divorce, the other spouse is completely lost. So for more reasons than one, it only helps to have these conversations with your spouse on a regular basis, because you just don't ever know.
Very good.
And I would say go to our website, download the Life Book, and there's a place in the Life Book where you can annotate all the passwords and things, and then store the Life Book in a secure location that both of you know how to get into the safe to get to the Life Book.
Which is at retirerelax.com.
You've been listening to Your Money, brought to you by Lifespan Wealth Management, proudly serving Middle Georgia for over 30 years. Our mission? Helping folks just like you plan for a secure and stress-free retirement. Need a trusted financial advisor? Call us today at 478-922-8100 and schedule your complimentary consultation at our Macon or Warner Robins office. Want to learn more? Visit us anytime at retirerelax.com. Because when you plan smart, you can retire and relax. And here's something extra. We offer free educational seminars for the community. If your group needs a guest speaker, give us a call and let's make it happen. That's 478-922-8100. Now, let's get back to the show.
Next topic, why you should never mail a check. We've talked about this before, but it's gotten worse, and I talk with all of my clients about this. Mailing a check might seem routine, but it's a practice that could cost you thousands. In 2023 alone, Americans suffered an estimated $21 billion with a B in losses due to check fraud, a crisis largely fueled by a deceptive scheme known as check washing. Check washing is a simple but terrifying scam. Criminals intercept your mailed check, use common chemicals to erase the ink, then rewrite the payee name and dollar amount before fraudulently cashing it. They're literally stealing your money and identity right out of the mailbox. The U.S. Postal Service has a warning on its website about mail theft and how thieves are targeting mailboxes.
And criminals are breaking into post boxes, in some cases even robbing postal workers so they can get the keys to the boxes. We asked our postman about this, and he was told if they have a gun, let them take everything, including the master key. Once they have the keys, they can get the mail out of the huge multi-person mailboxes and open up the mail that looks like a payment with a check. Then they wash that check, make themselves the payee, change the amount, and steal the money from you. In the worst case, they have those checks printed at one of those check printing services, and they've got a box of your checks, and they can have a field day writing the checks in your name. It's an ugly, ugly crime. The Post Service, in its own alert, says this: if you are mailing something with a check, a bill payment, or anything like that, don't use the outside mailboxes. Go inside the post office and drop it in their secure box.
So I have a client that did that, and it still got stolen on the back end.
Yeah.
or within the post office or somewhere.
I guess we're down to carrier pigeons again.
Right.
Right. Instead of using ballpoint pens, many people advocate for the use of gel ink pens, which contain ink that thoroughly penetrates the paper, making it impossible to wash a check. But gel ink pens, once viewed as an adequate countermeasure to prevent washing a check, no longer are a deterrent for the most sophisticated crooks. Many crooks are now scanning and reproducing checks, which they can easily modify rather than writing over them. Another option is to use certified checks, which are typically used for big purchases and offer more security features. With a certified check, the financial institution guarantees the funds and makes sure that only that amount can be cashed. And a certified check will typically cost a little more than a regular check. The best option, probably to pay your bills electronically.
If you have aging parents, ask to help set up auto bill pay for them. They may be too intimidated to try this on their own, or they may not even own a computer. This way, you can easily log in, monitor their bill payments for them, and give them a more serious peace of mind.
I agree with that. All right, let's talk about leveraged ETFs. So if you're considering purchasing leveraged ETFs, please proceed with caution. There is something in the air right now, or probably something in internet chat rooms that everyone is talking about, and it centers around high dividend ETFs and chasing dividends that come with them. So this segment is to provide you with some information about what some of this discussion is about. First, there are stocks and ETFs, or electronically traded funds, that are relatively safe and pay good dividends. Noble, NOBL, for example, is a ProShares S&P 500 Dividend Aristocrat ETF that holds a stable of stocks that have increased their dividend for at least 25 consecutive years. They are financially strong, mature, and stable. Investors can purchase a share of Noble for about $102 per share and gain a lot of solid companies that provide reliable stream of income. They receive a quarterly dividend yield, but the dividends received are modest, and today people are chasing high dividends that are taking excessive risks in the pursuit of high returns. On the other end of the spectrum are the high-risk leveraged ETFs. So let's talk about those. First of all, what is a leveraged ETF? It is a type of exchange-traded fund that tries to amplify the daily returns of an index, such as the S&P 500 or the NASDAQ 100. A 2x leveraged ETF aims to go up or down twice as much as the index in a single day. A 3x leveraged ETF tries for 3 times the move, that's up or down. They do this using financial derivatives like futures and swaps, not by just owning more stocks. And if you want to understand more about swaps, forwards, and futures, I would encourage you to simply Google those words, and there are several short primers on these subjects with great examples.
These were very popular during the 2008-2009 financial crisis, as markets were moving so much on a daily basis, and you could get in and out of them on a day-to-day basis. So you could win big or you could lose big.
Yeah, I agree. And I'll talk a little bit more about leverage ETFs, but Randy, back on the dividend chasing ETFs that seem to be a fad right now, just be careful with them. That is exactly what it is dividend chasing. If the dividend yield on an ETF sounds way too good to be true, it is.
It probably is.
It is.
And and these things too, Sherry, about what you were talking about, these things are not really meant for long-term investing either. I mean, these things you get in and out of them pretty quick.
Right. Okay, so here's some benefits of leveraged ETFs, although generally speaking, I don't think we can recommend them. But one, magnified gains in the short term. If you're correct about the market direction over a short period of time, you can make 2 to 3 times the return that the underlying index would make. Here's an example. The S&P 500 goes up 1% in a day. You're in a 3X ETF. You're going up 3%. Number 2, easy access to leverage. You get leverage without using margin. And I know this is a lot of technical terms, but you don't have to borrow money like you normally would to get leveraged products. So you can just buy these with cash. Number 3, trading and hedging. Active traders sometimes use leveraged ETFs for short-term trades or to hedge, protect. Hedging is protecting a portfolio against volatile periods.
These do come with major risks, though. 1, losses are also magnified. If the market goes down the wrong way, your loss are multiplied too. In an example, if the S&P 500 falls 1% in a day, a 3X ETF could drop 3%. 2, they reset daily. Leverage ETFs are designed to meet their goals on a daily basis only. Over time, the math can work against you due to something called compounding decay. If the market moves up and down a lot, volatility, but flat overall, you can lose money even if the index ends up where it started. 3. They're not suitable for long-term holdings. Because of the daily reset and the volatility drag, leveraged ETFs usually don't track long-term performance well. Holding for weeks or months can lead to results that are very different and often worse than you expect. 4. Higher costs. Management fees and trading expenses are higher than for regular ETFs since they use complex financial instruments. 5. Increased volatility. Expect big price swings. A 2 to 3x ETF can rise or fall much faster than the underlying index, sometimes dramatically within a single day.
All right. Well, here's an example of the volatility trap. Let's say you're working that you're looking at a 3x leveraged ETF that tracks an index, and we'll compare it to the index itself over 2 days. On day one, the index goes up 10%, and a 3x ETF should go up 30%. So 3x is 3 times, right? So 30%. If the index starts at 100 and ends up at day one at 110, the 3x ETF starts at 100, ends at 130. On day two, the index goes down 9.09%, which brings it back to 100, because 110 times 0.9091, too much numbers I know, equals 100. The index is back where it started. The 3x ETF will go down 27.27%. That's 3 times the index's daily move, and that's 130 times 0.7273. That's going to give you a result of 94.55. The result, the index is back to 100%, no gain, no loss. The 3x ETF has a result of a 5.45% loss. In our special report, your stock market survival guide, on our website, retirerelax.com, we discuss this and illustrate how negative compounding, the compounding decay, can hurt your returns. It is interesting that if you started with $200,000 and had a return the first year of 20% and then a negative return the following year of 20%, and you had that same sequence for 6 consecutive years, so up 20%, down 20%, 6 times in a row, most people would say you broke even. But in reality, you would have lost just about $25,000.
And interesting, it does not matter if the first year was positive or negative year. The same sequence of patterns will result in a negative return.
Why this happens? It's due to daily compounding and volatility. Every day's gain or loss is based on the new adjusted price, not the original one. When prices move up and down repeatedly, the leveraged ETF's losses are down on down days, eat up more than its gains on up days, even if the overall market goes nowhere. This is sometimes called volatility decay or compounding drag. Another thing is leveraged ETFs don't just multiply returns, they multiply the volatility. That works in your favor in a smooth uptrend, but hurts badly when markets whipsaw. Even if the market ends up flat, the leveraged ETF can end up lower.
Bottom line, leveraged ETFs can be a powerful short-term trading tool, but they're not meant for long-term investing. If you don't monitor them daily, they can quickly move against you. Most investors are better off sticking with standard ETFs unless they fully understand how leverage and daily resets work.
And Jonathan, we put this in this radio show today because of people calling and asking about them, and the people who are calling and asking about them know nothing about how to monitor and get in and out of the market, and they're just looking for higher returns,
Faster.
and they're watching the internet. They're talking to the people around the water cooler, and they're dangerous. They can lose so much money so fast, and all they're looking at though is the upside. They don't understand the downside,
Right.
which is why we wanted to put this on the show today.
Right.
So please be careful about who you're listening to, and what you're
Getting your advice from.
that's right, and what you want to get into, because you can lose your shirt quick.
For sure. And I love the example in here about how even if the underlying index gets back to square one, back to where it started, if you're in a leveraged ETF, you're down.
You're down.
You're still down even if its underlying is back to where it started. So it's risky and fairly bordering on dangerous to get in these.
I would say if you have not made it to where you are completely comfortable in retirement, that you know that you're set, and no matter what the market does, that you're going to be okay. Getting into something like this is probably the last thing you're going to want to do.
Yep. I agree with you.
Corey?
And something that this article didn't talk about is they also have inverse leverage ETFs,
Even worse.
which people think, oh, well, when it's going down, I'll just hop into the inverse and then I'll go back up. But that's just as dangerous to do.
Even probably more so.
Right.
Well, I mean, given the market's general tendency to go up over time, getting in an inverse ETF means that you're going to go the opposite direction of the market, right? So if you hang around in those too long, you do get it handed to you real quick in those.
And the bottom line is you have to watch it, if not daily, but hourly.
You do.
I mean, it's that big of a
You do.
deal.
I would not advise it.
All right, good conversation, guys. All right, risky loans from the housing bust era are making a comeback. The unaffordable housing market is causing a growing number of home buyers to take on a type of riskier loan to cut the borrowing cost. They're opting for an adjustable rate mortgages or ARMs. These loans initially offer cheaper borrowing rates compared to fixed rate mortgages, but ARMs reset usually after 3 to 10 years, which can saddle borrowers with higher monthly payments if mortgage rates have risen over that time. That isn't the only risk. Borrowers who want to refinance when rates drop might not qualify if they've had job losses or other changes in their financial situation.
I have seen this scenario, and it is terrible. This was back in 2008 during the housing crisis when people had locked into these loans, not expecting to lose their job, which they did when the market started to crash. The number of homes going into default caused a major recession. I don't see us going into a recession today, but job losses are happening all over due to the adoption of different technologies, and replacing your pay with the same amount could be difficult due to this massive job shift, so be careful.
But buyers are betting that mortgage rates will fall in the coming years, enabling them to refinance before the fixed term of their ARM loan expire. The average rate of a 30-year fixed mortgage in the 5 days ending October 29 was 6.15% compared to the 5.46 for the 5-year and 7-year ARMs. About 10% of the purchased mortgage applicants were for ARMs in the week ending October 3rd, the highest rate since 2023, according to the Mortgage Bankers Association. In early 2021, when mortgage rates were near historic lows, less than 3% of the purchase application were for ARMs.
I talked with a prospective client this week who has a 2.25% rate on a 30-year mortgage.
Hang on to that thing.
30-year at 2.25%. I couldn't even believe it. Buyers are desperate for affordable monthly payments when home prices are up more than 50% since 2019 and are near their all-time highs. And home insurance and property tax costs have also climbed in many parts of the country. Mortgage rates generally tend to track government borrowing costs, but ARMs, that is, adjustable rate mortgages, are more correlated with short-term rates, while fixed-rate mortgages are more correlated with 10-year Treasury yields. Mortgage rates could keep declining if the Fed continues to lower rates, but the Fed's decisions have been complicated by the government shutdown and lack of economic data releases.
So the bottom line is be very, very careful.
Yep. All right, let's talk about why cybersecurity is a business essential for small companies. Cybersecurity Awareness Month was October, but it really should be an everyday event. But it is a reminder that the risks facing business owners today look very different from what they did a few years ago. Fraud attempts are no longer simple or opportunistic. They have become smarter, more targeted, and powered by new technologies like AI. For small businesses, this represents a unique challenge that you cannot afford to ignore. While you might not see yourselves as prime targets, cyber criminals view smaller companies as prime entry points because you may lack the same defensive resources as larger institutions. But let me be clear, resilience is not about size. It comes from focus and preparation. Your bank is a partner too in this fight, but the first line of defense against financial loss begins with you. Fraud attempts continue to rise, and they have shifted from one-off random attacks into multi-stage, long-term strategies. As shared recently in Alloy's 2025 State of Fraud Report, 71% of fraud attempts are committed by organized crime rings. Cyber criminals may steal data today and strike months or even years later. As the frequency of banking scams has increased 65% in the last year, now it is more important than ever to understand how attacks have advanced and so what to look out for to secure your business.
Fraudsters can now mimic a business caller's ID, create replicas of legitimate websites and invoices, and even mimic a familiar voice, all to create a sense of trust and legitimacy to gain sensitive information. This includes impersonating businesses you may work with, including your vendors and your bank. Business impersonation has become one of the most realistic and effective forms of phishing because it plays on instinct. Panic first, think later. While AI helps to make these schemes feel authentic, the first defense is awareness and reading the signs. If something feels off, it likely is. So how can you build stronger controls? Every business should regularly assess how transactions are managed, which employees and vendors have access to sensitive systems, and what controls are in place to detect suspicious activity. It's equally important to create an environment where employees understand their role and feel empowered to protect the business.
So I got a new one for you guys. I got a text yesterday from an unknown number.
Okay.
Here's what it reads. Please remove any construction parts left by my steps. And I didn't answer it. I just left it alone.
That's what they
because
want you to do is answer
They
it.
want me to answer it. And I thought,
right.
first of all, I'm not even doing any construction. Like, what is this?
Well, here's another one that they've started doing too. Is they will send you a calendar, and wanting that it's like they're
Setting an appointment?
they're setting an
I've gotten
appointment for you.
many of those.
And that's just started. In
Don't
the last
forget
month.
about our appointment.
That's right.
Yep.
And so
And there's a link in there, and it says,
Yeah.
click on this link to confirm.
Yep.
Ooh, man, it's bad. Our firm, fortunately, has always taken cybersecurity very seriously. Our broker-dealer in the last 8 to 10 years has really ramped up their cyber protection and education efforts. We have a cyber surveillance program that runs silently in the background on all of our computers. This software analyzes every site we visit and sometimes prevents access to sites that we need to go to in our normal conduct of business. But the site may not have ample protection, or it may be unsafe in other ways that we would not know about. So we're prevented from visiting that site. Not everyone or every business is this fortunate. We have good training, too, from our home office. Training employees to spot red flags and knowing when to escalate becomes a collective asset. And leadership sets this tone. Cybersecurity should be discussed as part of everyday risk management, not treated as an occasional IT issue. The most secure businesses are those that work to stay vigilant as a team.
All right. So you know what the weakest part of every business computer network is, right?
My guess is that it would be the human aspect of
That's
the computer
right.
network. When it comes to getting viruses or installing malware on a business computer network, it has to be done by a human hand. We have learned time and time again in our cybersecurity training that hackers or people with ill intentions target people when they want access to a computer. When it comes to installing something that shouldn't be on your computer, it is unfortunately easier to trick a human than it is to trick a computer. Many of the attacks work on building trust with people to lure them into doing something on their computer that they should not have done.
Strong relationships with financial institutions play a central role. Having a trusted banker or advisor who understands the business and can recognize irregular activity is invaluable. Fraud is no longer a matter of if, but when, and those personal connections allow faster and more coordinated responses to emergencies. To stay protected, business leaders need to rethink and understand how money moves through their organizations and the potential flaws of their processes. Modern financial tools are not only more accessible and convenient, but they offer more protection. Together, these methods give small businesses the same level of sophistication and protection once available only to larger institutions. For example, ACH and wire transfers secured with multi-factor authentication verify every transaction before funds actually move. Positive Pay helps detect altered or counterfeit checks before they clear. Bill pay platforms protect account details and create a controlled environment for routine payments.
And banks are essential in this evolution, working alongside businesses to strengthen defenses. Behind the scenes, banks monitor transaction behavior, verify business credentials, and flag anomalies through internal programs. While those extra steps may make account opening and security checks feel cumbersome, they are essential measures to keep businesses safe. Fraud detection is getting better. We often get a text or call from our bank or credit cards to validate charges or debts in our account.
When an attack occurs, speed matters. Contacting your bank, freezing compromised accounts, changing credentials, and documenting every step can help investigators and financial institutions contain the threat and begin recovery. The most successful outcomes come from knowing what to do before an incident happens.
That's right. Even the most prepared organizations can experience a cyber incident. What sets apart lasting damage from temporary disruption is how efficiently a business responds. A clear, actionable recovery plan should identify which systems are critical, who to contact immediately, and remember your bank, and how to resume operations quickly. For business leaders, the goal isn't to eliminate risk, but to manage it thoughtfully, protect what's been built, and ensure that innovation and growth continue with confidence. The future of your business depends on it. We have a business continuity and a cyber response manual that addresses all of these issues. In times of duress, these manuals can help you keep your focus and keep you from losing control of an already bad situation. I would encourage every small business owner to take the time to compile your own business continuation and cyber response manual. They're not difficult to create and take very little time to review and update annually. Stay prepared and stay safe.
Excellent. All right, next up, love you, hate your debt. Couples seek prenups as student loan debt reaches $1.65 trillion. Student loans moving into serious delinquency outpace other debt types, forcing those intending to marry to look at protecting their finances from their partner's liabilities. America's love affair with credit appears to be undying, with new stats showing household debt reached $18.59 trillion at the end of the third quarter of 2025. First, to put the nation's debt into perspective, the data released today by the Federal Reserve Bank of New York shows that household debt rose 1% quarter over quarter, adding $197 billion to the almost $19 trillion of debt. For student loan debt, there was a $15 billion rise in the third quarter and a $47 billion increase year over year to bring the total to $1.7 trillion, roughly in line with auto loans. Economic research from the New York Fed show the relatively low mortgage delinquency rates reflect the housing market's resilience driven by ample home equity and tight underwriting standards. However, the report revealed that for student loans, the transition rate to serious delinquency went from 0.77% in 2024 to 14.26 in 2025.
That's a monumental.
That's big. That's more than double the rate for credit cards, which are the second highest in this regard. It's worth noting that missed federal student loan payments that were not previously reported to the credit bureaus between 2020 and 2024 are now appearing on credit reports. That's the problem. How do you buy anything together if one party can't be part of the financing?
Wow. And against this backdrop, it's perhaps not surprising that couples see prenups more like debt shields than wealth preservers, according to Legal Shield. The firm survey found that around 77% with student debt would consider prenups, and those with student debt are 6 times more likely to have a prenup. While marriage is usually based on love, it is now defined by debt. Prenups have become essential protection for young couples facing heavy financial burdens due to the student loan crisis. This is terrible.
It is. A spouse is not responsible for a student loan debt unless they co-sign. But I think this is more about keeping finances separate to protect the spouse that has the positive credit rating.
Yes. I also wonder if the person wanting the prenup wants to make sure they are protected in the case of a divorce. Divorce among young couples is so much higher than it is for our generation. That makes more sense to me, but they still wouldn't have to pay off the partner's student loan, but they could have to compensate for other debt that they have as a couple, just like our daughter had to do when she went through her divorce.
And you can't blame them. I mean,
yeah.
All right.
Anyways, why do people procrastinate on critical issues like saving for the future? People procrastinate about investing due to a mix of psychological biases, practical barriers, and emotional fears. These factors combine to make investing, which is inherently complex and uncertain, feel overwhelming and risky. Let's look at psychological biases. Loss aversion. The pain of losing money feels psychologically more powerful than the pleasure of gaining an equivalent amount. This can cause people to be overly conservative with their investments or to hold on to a losing stock for too long. Present bias. This is the tendency to prioritize immediate rewards over long-term benefits. Since investing requires sacrificing money today for future gains, the perceived loss or cost of saving now can feel greater than the potential long-term reward of compounding.
Yep, and then there is status quo bias, the preference to keep things, and I see this a lot, the preference to keep things the same leads people to avoid making any changes to their financial situation, even when a change would benefit them. An investor may stick with an initial, possibly suboptimal decision rather than actively managing their portfolio. Overconfidence and overanalysis. At different ends of the spectrum, both overconfidence and analysis paralysis can cause inaction. An overconfident investor may believe that they can time the market perfectly and thus keep waiting for the ideal time to invest, which rarely comes. On the other hand, a meticulous planner may become paralyzed by the sheer volume of information and choices, leading to an endless cycle of research without action.
And of course, there are several practical barriers, such as the lack of knowledge. Many people are intimidated by complex financial terms, and they feel the lack of expertise to make informed decisions. There's perceived insufficient funds, competing priorities, and feeling overwhelmed.
There's also emotional factors, which include fear and anxiety and past negative experiences. A lot of these were felt during the 2008 recession, and they have lasting perspectives.
But there are some strategies to help overcome investing procrastination. That is it, and we are at the end of the show. Thank you so much, everybody, for listening, and have a great week.
Thanks for listening to Your Money, produced by Lifespan Wealth Management. As financial advisors, the main thing we do is provide retirement planning and advice and manage our clients' investment accounts. If you're looking for a financial advisor, please contact our office at 478-922-8100 to set up a free consultation. You can learn more about us by visiting our website, retirerelax.com. If you have a question or topic you'd like for us to address in a future broadcast, email Randy at rfmoney.com. We look forward to connecting with you next week. Have a great weekend, everyone.
Securities and investment advisory services offered through Osaic Wealth Incorporated, member FINRA SIPC. Osaic Wealth is separately owned, and other entities and or marketing names, products, or services referenced here are independent of Osaic Wealth.